Hi everyone, Calvin here. In this video, I'd like to talk about what happened last week regarding GameStop stock, which everybody is talking about, but many people still don't understand what exactly happened. So today I'd like to explain what happened last week in a very simple way as a neuroscience PhD who is also preparing for CFA exam and also actively trading stocks. Before we start, please smash the like button below and destroy the subscribe button if you haven't. Thank you very much. I personally did not trade GameStop stocks, but here's my understanding from my reading about what happened last week. As you probably already know, and as the name suggests, GameStop is a video game and consumer electronics and gaming merchandise retailer. It's headquartered in Grapevine, Texas, which is very next to Dallas. It has over 5,000 retail stores across US, Canada, Australia, New Zealand, and Europe. It was founded in 1984. Its 2019 revenue is over $6 billion, but its net income of that year is actually minus $470 million. Still in 2019, it had 14,000 full-time employees and up to 42,000 part-time employees. That's quite big compared with some company of 150 people also trading stock markets. Its asset in 2019 was very close to $3 billion, and it had owned, of course, many subsidiaries. For those who don't know, subsidiaries are basically child companies. The company was quite successful until 2016. It was really popular among people who were then teenagers and then early adults, and now become adults and earning money. It was really part of their teenage life when they're really into video games. This is really important as a background of last week's story. But since 2016, market condition has dramatically changed because physical game media is less needed as online services become more popular, such as Xbox Live, PlayStation Network, and Nintendo eShop, and Steam, which offers downloadable digital version of the games. This resulted in lower in-store traffic. Then in 2017, the company made bad policies, which were not welcomed by its employees. Also in that year, the company closed 150 stores due to more popular digital games like Xbox. Its management wanted to sell the company, but couldn't find a buyer who would pay a fair price. The company's financial condition further declined. In 2018 alone, it reported a record-breaking net losses of $673 million. Then the stock was traded around $13, more than 50% down from $30 in 2016. In 2019, the company tried to reposition itself by revamping stores to focus on retro gaming and competitive gaming. And of course, reorganized and laid off a bunch of people. In August 2019, Michael Burry, the one-eyed investor who successfully predicted 2008 financial crisis, at the time owned 3% of the company's stock and urged the company to buy back some shares. After Q2 2019, the company closed another 180 to 200 stores, but still cannot turn around its financial situation. Then some members of the board of directors were replaced in March 2020 when the pandemic hit. Then all 3,500 stores were closed from March to May 2020. Even though it experienced 30% drop in retail, its digital sales grew by more than 500%. Due to this difficult time, many of its leadership took 30 to 50% pay cut. Then late January this year, last week, the famous GameStop saga began. Long story short, some Wall Street hedge fund firms, Melvin Capital, not Calvin Capital, okay, predicted that GameStop stock price will go down, and they took short position. Short position basically means that selling stocks by borrowing from financial institutions with a promise to return the same amount of stocks after a specified period of time. For example, in this case, let's assume Melvin Capital borrowed 1 million GameStop stocks from Bank of America on January 1st. This is assumption. A lot of number here will be assumptions. Of course, Bank of America would hold on to a collateral provided by Melvin Capital for a period of time until Melvin Capital returns the same amount of GameStop stocks. Once Melvin Capital borrowed 1 million GameStop stocks, they would start selling them in stock market. This would cause some price decline. Then their short position was reported, or should I say, they themselves reported their short position. They hoped that this news would further decrease GameStop stock price. This way, when they later buy back the same amount of stock, they can buy at a very cheap price. But that didn't happen. Their short position on GameStop got a Reddit post attention from people who were or still are GameStop fans or customers. These people didn't want to see GameStop bankrupt because GameStop is their childhood and teenage memories. Then they started talking about pushing the stock price up to make the hedge funds loss from their short positions. And they did it. Another reason is that they, as individual investors and stock traders, kind of hated institutional investors like these hedge funds who often use their special relationships and advantages and benefit from individual investors' losses. Stock market is a zero-sum game where if you earn money, there must be someone who have lost their money. Some people call it revenge. Through the Reddit board, these GameStop fans were united and started buying its stocks and pushed the price up to $150 on January 25th, Monday, from $19 on January 12th. Then within 2 days, this event got a lot of attention. Even Elon Musk tweeted about it. Right after that tweet, it shot up to $350. Right around that time, Melvin Capital, which was the main one targeted by the Reddit board, announced that it took a huge loss and closed out its short position in GameStop. To prevent it from bankruptcy, Citadel and Point72 infused $3 billion into Melvin Capital and saved it. News says that Melvin Capital took 53% loss, $4.5 billion. Even then, GameStop price did not stop there. Instead, it rocketed up to $469 on Thursday, January 28th. Until Robinhood, which is a trading platform and probably some other trading platform as well, started manipulating the free market by allowing the individual investors only to sell but not to buy GameStop stocks. And probably BlackBerry as well, which was also rising then. Some say that while allowing institutional investors to buy and sell freely, some said that this trading platform conspired with some institutional investors who were still in a short position to keep them from losing more money. Of course, this was immediately discovered and got a lot of people's attention, including Ted Cruz, who retweeted Alexandria Ocasio-Cortez's tweet, a Democrat. A rare bipartisan. I'm wondering if the former President Donald Trump still had his Twitter account. What would be his tweet? Anyway, stock traders were angry. Later that same Thursday, Robinhood was sued. Later on the same day, after the stock market was closed, Robinhood announced that it's going to re-allow individual investors to purchase GameStop stocks. Then on Friday, the stock price was back to $379 and closed at $325. Of course, SEC started investigating Robinhood market manipulation. Let's see what's going to happen. Today, February 3rd, Wednesday, GameStop closed at 92, a 2.68% increase from yesterday's close price. And that's the whole story of what happened last week. The reason that this GameStop saga got so much attention is probably because this kind of event probably never happened before or never happened at this large scale. Then on Monday, this GameStop style frenzy trading targeted silver and a movie theater chain called AMC and drove their prices up. But by Tuesday, the frenzy quickly went away and the prices dropped to normal. Last week, some people and even some experts were saying that this GameStop style trading might become a normal part of stock trading. But their prediction seems to going to fail. Certainly those people who bought when not many people were aware and sold when everybody were talking about it probably benefited the most. And those people purchased at the peak price definitely took a huge loss by now. Those who buy at peak prices are often new traders who have little experience. From the losses, some of them probably will never go back to stock trading again. You see, tradings of silver and AMC were not as crazy as that of GameStop. That means that people have realized that they have been took advantage of and don't want to do it again. And they changed it back to their normal state from last week's crazy state. So I think it's a rare event, a black swan. That's pretty much it for today, and I hope you enjoyed watching. Don't forget to click the like button below and subscribe to my channel if you haven't. Thank you very much, and as always, see you next time.